Hello everyone and welcome. My name is Elliot Gu. I'm the co-founder and editor of the Smart Bond Service. And today I want to talk about something that might surprise some of you who are longtime readers or followers of mine, and that is politics. Don't normally like to talk about politics in the services I write for and run and manage over the years, but today I want to talk specifically about the politics of monetary policy as well as the US bond market and what it all means for the US bond market. And I know many of you are probably aware that the US Federal Reserve is considered an independent central bank, which basically means that the Federal Reserve, the central bank, sets monetary policy independent of the US federal government, their spending decisions. So fiscal policy, government spending, taxation, the level of the deficit, is an independent process from monetary policy, the level of interest rates, bank reserves, and the like. And that's true to a certain extent, and it's true in most central banks in developed countries are considered independent central banks. They're supposedly make decisions independent of the fiscal authority of the central government. But when the level of U.S. government spending is as high as it is right now, the level of U.S. government borrowing deficits to meet that spending is as high as it is right now. I'll show you more about that in a moment. It's impossible, or very, very difficult at a minimum, to completely separate monetary and fiscal policy. And I'll show you what that has meant for markets over the last 18 months to 24 months. And I'll also explain why I think it's actually quite bullish for the U.S. government bond market and the U.S. bond market generally here over the short to intermediate term. So let's get started with this first chart. And this is a chart from the Investment Company Institute, which simply shows the total amount of assets held in U.S. money market funds. And so what you can see is that in early 2023, there was about $4.8 trillion held in U.S. money market funds in total. And as of the most recent week, and I believe this was actually data as of September 11th, 2024, there were $6.25 trillion in U.S. money market funds. So in a period of less than 2 years, from early 2023 until September of 2024, the amount of money in U.S. money market funds is up by right around $1.45 trillion, almost $1.5 trillion US dollars. So how come money market funds have become so popular over the last 18 to 24 months? Why have the assets in these money market funds surged so much? Well, of course, there are many different answers to that question and many different correct answers to that question, but the most direct and the most obvious is that yields on those money market funds have really surged over an equivalent period. So what this slide shows is the blue line is that same money market fund assets chart that I showed you, line that I showed you on the prior slide, showing that rise from early 2023 to September of 2024 of about 1.45 trillion. That orange line is the yield on one particular money market fund, the Vanguard Money Market Fund. Symbol there is VMFXX. Full disclosure, it's a name that I've recommended in some of my publications for some time now. It's also a name I've owned myself. It's one of the larger, more popular money market funds for individuals out there. And that orange line shows the yield on that money market fund over the same time period as my chart of money market assets. And you can see that when yields on money market funds really began to surge in this area that I've drawn inside the circle, we got up to late 2022, early 2023, we got up to 3, then 4%. That's when the assets held by these money market funds really took off. So individual investors poured money into money market funds because the yields became very, very attractive on those funds. Now, the obvious question is, what exactly do money market funds own in the United States? And over the last 18 to 24 months, there really have been two main answers to that question. The first answer is Treasury bills. So these are short-term U.S. government bonds. These are U.S. government bonds with a maturity of less than 1 year. So 1 month T-bills, 3 month T-bills, etc. The second answer to the question has been what's known as the reverse repurchase facility or reverse repo facility, which is a pot of money at the Fed, which basically it's a facility at the Fed which allows mainly money market funds is the main users of it right now to park cash at the Fed on a short-term basis and earn a yield which is pretty close to the effective Fed funds rate. So the level of interest rates set by the central bank. So money market funds over the last 18 to 24 months have generally been invested in government bonds, short-term government bonds, T-bills, or that reverse repo facility. Both of those are considered risk-free assets. The federal government can repay the money it borrows in T-bills because it borrows in US dollars and it can also print US dollars, right? And the reverse repo facility, of course, is guaranteed by the Fed. It's paid an interest rate by the Fed. The Federal Reserve, the central bank, can create money to pay interest on the reverse repo facility. So those are the two buckets where the money market funds assets have been, either T-bills or the reverse repo facility. Now, this has not gone unnoticed by U.S. Treasury. And as I said, the U.S. government is spending more money today than it has at any time in its history outside of World War II. So if you look at this chart, I took this back to 1930, and this shows total U.S. government outlays, which is federal government outlays, which is spending, right, as a percentage of the size of the economy, as a percentage of GDP. And I took this, as I said, back to 1930, and what you can see is that in World War II, in the early and mid 1940s, the U.S. government spent more than 40% of GDP, and that was mainly aimed at defense. You saw another little surge, which I've also labeled here, in that 2008-2009 period, which corresponds to the Great Recession and financial crisis years of 2007 to 2009, roughly. So the U.S. government spent a lot of money during that period. And in fact, if you squint at this chart hard enough, if you look and see where the recessions were, like 1973, 74, the early 80s, the early 90s, that 2001 period, you'll see little surges in U.S. government spending during recessions. That's pretty normal. The U.S. government spends more money, fiscal stimulus, right, in an effort to help the economy out of recession. Some of that is automatic, right? Things like unemployment benefits are a level of government spending that is automatic when the economy sours and unemployment rate goes up. You can also see, though, however, that coming out of those recessions, spending usually declines back to a more normal level. It's a temporary surge in stimulus to help the economy recover from recession, followed by retrenchments in spending. We did not see that out of COVID, though. You can see that big spike I've also labeled here to more than 30% of GDP in spending coming out of the immediate stimulus, coming out of the lockdowns and travel restrictions imposed in the early days of the COVID outbreak. But then, while government spending came down a little bit, it's remained around that 24 to 25% of GDP range ever since. It has not come back down to the same degree that it normally does coming out of a recession, despite the fact that the 2020 recession was one of the shortest and mildest, right, in terms of length in U.S. Economic history. Most recessions last 6 months to 18 months for the Great Recession. That recession was really only a couple of months long, and then the economy entered a recovery. But spending never came back down. This chart also shows projected spending out through fiscal year 2029. And you can see that there is no expectation that government spending will come down out through the end of this decade. So that begs the question, the government can't really raise taxes, at least in the short term, to cover all of those deficits, cover all of that spending. So obviously it's borrowing a lot of money to fund that spending. So it's running a huge deficit, it's having to borrow money to fund that spending. So how does it borrow money? Well, since the middle of 2023, the answer to that question has been Treasury bills. And it's related to that chart I showed you a little while ago of money market funds. Now, if you remember, in the first half of 2023, the first 5 months of 2023, there was a big political debate going on in the United States over the debt ceiling. So this is a limit on the amount of debt the government, the central government, the federal government can owe. And there was a lot of horse trading and back and forth in Congress to try to come up with a deal to raise the debt ceiling and allow the government to continue borrowing money to meet all these spending obligations that it has, and the spending that it's been racking up over the last few years, and to pay the interest on the debt, etc. So in June, a deal was struck between Republicans and Democrats to raise the debt ceiling. And so the government could issue debt again, borrow money to meet all of its spending needs and replenish its coffers. And what you can see here is that this chart shows the percentage of Treasury bill, bond, and note issuance, right? So this is the percentage of all the money the government's borrowing, right? Every quarter, going back to 2010, right? In the form of Treasury bills, rather than Treasury notes, intermediate term bonds, or Treasury bonds, which are long-term, long maturity bonds like the 30-year. So you can see that normally for most of this period from 2010 all the way up through 2016, 2017, normally about 70 to 77% or so of Treasury issuance was bills rather than notes and bonds. We saw a big spike over 85% during COVID lockdowns in early 2020. That's normal. When the government has to borrow money quickly to fund an immediate need for spending, emergency spending, as it did back in early 2020, it often relies on short-term government bonds, on Treasury bills, to meet those immediate cash needs. What is unusual, though, is that since the middle of last year, since roughly June of 2023, right, the federal government has relied very heavily on short-term U.S. government bonds to meet its funding needs, to meet its needs to borrow money. And the reason for that, as I alluded to earlier, was that up until the middle of last year, there was a lot of money held by money market funds in that reverse repo facility at the Federal Reserve. And this is a chart showing the total assets held in the reverse repo facility at the Fed from early 2022 all the way up till the present time. And what you can see is that in June of 2023, and this is something that's come to be called the Yellen pivot, which I think I also labeled on that prior slide, the Treasury began to rely heavily on those short-term bills to meet its funding needs. And the reason it did that is because there was more than $2 trillion held in money market funds, right, by money market funds in that reverse repo facility at the Fed back in June of 2023. And the Treasury began issuing an avalanche of bills in the middle of 2023. The yields on those Treasury bills were slightly higher, just a few hundredths of a percent, a few basis points higher than the yield on that reverse repo facility. So a lot of money market funds took money out of the reverse repo facility and put it into Treasury bills. They bought U.S. government, short-term U.S. government bonds. This allowed the Treasury to sell enough bills to meet its funding needs. That's why you saw that huge jump in issuance of bills, because the Treasury was relying on money market funds to take money out of the reverse repo facility and place it into short-term U.S. government bonds. Now, as you can see, from June of 2023, more than $2 trillion in that reverse repo facility, to the present time, somewhere around $300 billion in that reverse repo facility. Treasury bills, or money market funds, have taken a lot of money out of the reverse repo and put them into those T-bills, allowing the government to fund all these spending needs. The problem with this is twofold. First up, the cost of borrowing money in Treasury bills has been pretty high. The yield on Treasury bills has been somewhere in that 5.35% range since the middle of 2023. So the government is able to rely on these money market funds shifting assets out of the reverse repo facility and putting them in Treasury bills to raise debt, to issue debt. However, it's paying a pretty high rate of interest on those bills. As I said, the rate there is around 5.35%. The yield on a 10-year U.S. government bond for most of the period since the middle of 2023 has been somewhere between 4% and 5%. The high was right around 5% in the fall of 2023. So you can also see why an investor might not be particularly interested in long-term government bonds that are yielding less than T-bills. In particular, if you go back, and I'll show you a chart about this in a minute, to the fall of last year, there was a lot of talk about higher for longer interest rates. There was a lot of talk that inflation was still out of control. The government might actually have to raise interest rates, or the central bank might actually have to raise interest rates even further, hike additional times. And so in that environment where you've got a treasury bill yield of 5.35%, you've got a 10-year yield of 5%, and the prospects that short-term rates might go even higher, buying that 10-year U.S. government bond really doesn't look particularly attractive. Locking in a lower rate for a longer period of time than what you can get in the short-term money market doesn't look that attractive. Now, that also meant that, as I'll show you in a minute, that the government struggled to actually sell longer-term notes and bonds. There wasn't enough demand from investors, real money buying, to absorb all the supply of notes and bonds the government wanted to issue to finance its debt and to meet its spending needs. Now, there is one way that this can be fixed, if you will, and that is through monetary policy. So this is a problem at the Treasury, the fiscal authority, but it also impacts the central bank. If the central bank were to cut interest rates, then the yields on those short-term T-bills will come down. And by extension, it also makes longer-term notes and bonds look more attractive. If the yield on Treasury bills drops enough, and the yields on Treasury bonds is still up around 4%, say, then locking in your money at a longer-term rate at a higher yield suddenly looks attractive. If the yield curve disinverts, where short-term rates are lower than long-term rates, those longer-term rates are going to look more attractive to a buyer of bonds because they will be more willing to lock in those higher long-term interest rates and buy notes and bills notes and bonds instead of just buying short-term Treasury bills and relying on money market funds to shift money out of the reverse repo facility, which, face it, is already at an end because that reverse repo facility has gone from over $2 trillion in mid-2023 to about $300 billion today. There's not a lot left to be shifted out of reverse repo and into T-bills. The second issue, of course, is that Treasury and Congress some years back, about a decade ago, came up with a paper, basically a research project, setting guidelines for what percentage of Treasury debt should be notes and bonds versus short-term bills. And right now, the amount of bill issuance is so elevated that short-term debt is a much larger percentage of total government debt than what the Treasury says its target is and what's considered an ideal funding mix. The current Fed funds rate is 5.33%, the effective rate, which is right in the middle, roughly, of the target Fed funds target rate of between 5.25 and 5.5%. However, over the period from now until December of next year, of 2025, the Fed funds futures market expects the Fed to cut interest rates by 250 basis points. Right now, for example, the next Fed meeting is on September 18th, which is this coming week. And right now, the Fed funds futures is pricing in a 100% chance the Fed cuts 25 basis points and about a 50-50 chance, 50% probability, even money, that the Fed cuts by a full 50 basis points at its next meeting on September 18th. And then this chart shows the expected Fed funds rate currently priced into Fed funds futures at every Fed meeting, following every Fed meeting from September 18th of 2024, next week, until December 10th, 2025, which is the central bank's final meeting next year. And you can see that over this time period, the Federal Reserve is expected to lower interest rates by 250 basis points, that's 2.5%, to right around 2.8% by the end of next year. Now, as I said, the problem that the Treasury has faced has been weak, not enough demand for Treasury notes, intermediate term bonds, and longer term bonds like the 30-year to absorb the supply of debt they'd like to issue. That's forced them to rely on short-term bills where demand has been high from money market funds buying those bills. So they haven't been able to issue notes and bonds in the quantity they would like to because there's not enough investors out there, real buyers, willing to buy enough of that debt to meet the sizes of the auctions they need to do, the size of the note and bond issuance they need to make to meet their funding needs. So one of the things I like to do is to watch the government bond auctions. So when the government has an auction, it's issuing new debt. So it's issuing new bonds. And these happen almost every week of the year. Of various maturities. So, one day they'll have an issue of an auction of 10-year government bonds. Another day they'll have an issue of 5 years or 3 years or 30 years or Treasury inflation protected securities. And I look at a number of different statistics which are published on the federal government's website for how those auctions go. And there are 3 buckets I like to look for in terms of who buys the bonds the government issues, right? And there are 3 buckets of buyers. You have direct bidders. Generally, these are individuals or U.S. companies or banks, corporates. So these would be direct buyers. You have indirect bidders. This is usually foreign buyers, and in particular, foreign central banks, so foreign monetary authorities buying U.S. government bonds at auction. The third basket of bidder is what we call primary dealers. Now, primary dealers are big institutional buyers like JP Chase, for example. These are banks, financial institutions, which are tasked with creating a market in U.S. government bonds and literally handling the auction of new Treasury bonds, notes, and bills. So what you don't want to see in a Treasury auction is primary dealers taking up a large percentage of the auction. The reason is that the primary dealers really only step in to buy treasuries at auction when there's not enough demand from direct bidders or indirect bidders, domestic individuals and corporates or foreigners, to soak up all the supply. And then when that happens, when demand is weak, when real demand is weak, then those primary dealers are tasked with or required to step in and basically absorb any excess supply. So what happens is companies, banks, like financial institutions like JP Chase get stuck with a large portion of the bond auction. Now what I'm showing you on this slide is actually pertains to every 3-year note auction and 10-year note auction going back to the middle of 2022. So this is every auction over that period. And what I'm showing you here is at every one of those auctions, what percentage of the auction was absorbed by those primary dealers. And I want you to look at this closely. You'll see that, for instance, here in late 2023, so look at the period, look at those auctions in October, November of 2023 of last year, when the primary dealers absorbed a large portion, tended to absorb a large portion of those government bond auctions. Now, if you remember, that was the period when there was a lot of talk about higher for longer interest rates, the need for the Fed to hike more to bring down inflation, talk about yields maybe rising to 7% on the 10-year. And think about it. Who in their right mind is going to buy a 10-year U.S. government bond? The high yield for the 10-year in the fall of 2023 was somewhere around 5%. Who's going to buy a 10-year government bond at 5% yield, lock in that yield for 10 years, right? When you can go out and purchase a 3-month T-bill yielding 5.35%, 3%, and possibly going higher if the market was right at that time and expecting the Fed to maybe even maintain or hike interest rates from that already elevated level. So as a result, there wasn't a lot of demand from either domestic buyers, direct bidders, or foreign buyers, indirect bidders, to absorb the supply of bonds and notes that the Treasury did try to auction off. So primary dealers got stuck with a large portion of the auction, and the Treasury saw this weak demand and responded by issuing more bills instead of, as I said, notes or bonds. The Yellen pivot, as I mentioned earlier, relying a lot on that short-term funding. But look at the far right-hand side of this chart. Since July, August, we've started to see demand at these 3-year and 10-year Treasury auctions improve markedly. And that corresponds to the time when the market began to price in expectations for the Fed to start cutting rates more aggressively into late 2024 and through 2025. Because short-term rates are expected to come down, that means that short-term T-bill rates, yields available on Treasury bills, money market funds, etc., is going to be coming down. That makes those longer-term bonds still yielding, on the 10-year sort of 3.8%, 4%, a little higher on the 30-year. Those higher rates on those 10 and 30-year bonds, it makes them look more attractive now that short-term rates are coming down. Sure enough, we've seen a surge in demand for those longer-term notes and bonds, and that's showing up in the fact that in last week we saw an auction of both 3-year notes and the 10-year treasuries, and for both of those issues, the percentage of the issue absorbed by primary dealers was about as low as it's been any time in the last 18 months to 2 years. So demand, direct demand and indirect demand for Treasury bonds and notes is improving because short-term rates are expected to come down. I would expect to see that allow the Treasury to shift more of their issuance in favor of these longer-term notes and bonds. I'd also expect, and I think this is where the bullishness may come in for the U.S. government bond market, and really the U.S. bond market in general, corporates too, is that because a lot of people have been sitting in these money market funds in these short-term T-bills, earning that 5.3% yield, as that yield starts to become less and less attractive as rates come down, it's going to encourage some of that money to come out of money market funds entirely. The money market funds are not able to directly buy Treasury notes or bonds, anything with longer than a year's maturity. I think you may start seeing some of that money come out of money market funds and be reinvested into longer-term, intermediate and longer-term U.S. government bonds to lock in those higher yields. So I think we're already seeing a big pickup in demand for duration, for longer-term government and corporate bonds, and that is behind a good bit of the rally we're seeing in the bond market recently, here over the last 4 to 6 weeks. And it's one of the reasons why in the Smart Bond Service we've shifted a little bit more of our exposure in favor of intermediate term and longer term, mainly intermediate term, corporate and government bonds here since August. And I think this is a rally that could continue for some time. More broadly, I think it underlines a key point, which is that the Fed, a lot of people ask, well, why is the Fed going to cut interest rates? The economy is still doing okay, or at least we're not imminently slipping into recession. And inflation is still a little bit above the Fed's target rate, right? Well, one of the reasons may be something that I don't think is talked about enough, which is that at the current level of interest rates, the government's struggling to fund itself. Not in an absolute terms. They can always issue more bills. They could always issue more bonds at some rate and be able to fund the deficit. But the problem becomes a couple of things. First of all, if they're having to pay up a higher and higher rate of interest to borrow money, it means that the Treasury's debt service costs, the government's funding costs, interest costs go up dramatically. And that becomes a political problem, a political liability for the U.S. The other issue is that it has a circular impact back on monetary policy. The Federal Reserve, one of the main assets on their, or one of the main liabilities on their balance sheet is bank reserves. So this is money held by U.S. commercial banks at the Fed, right? And what it represents is it represents deposits that those banks have. They park some of that money at the Fed and earn a yield. And of course, they lend some out. But ultimately, a falling reserve balance at the Fed tightens availability of credit. In fact, that's the most direct way of tightening credit. When bank reserves fall, banks have to lend less money out. That's what underpins all lending and credit across the U.S. economy. And if consumers are taking money out of their checking account, or companies are taking money out of their checking account to buy bonds, which is direct bidding, right? Then they're removing deposits to buy U.S. government bonds, which has the effect of lowering those bank reserves and tightening up the monetary side of the equation as well. So I think while the central bank will always probably tell you that their choices are totally independent of what Treasury is doing, the reality of a country the size of the U.S., with a government budget the size of the U.S. budget, with the level of the deficit spending and general spending we're seeing now, is that Fed monetary policy has major impacts on the Treasury's ability to fund itself, how it funds itself, and the Treasury's choices on that end have a major impact on the level of bank reserves and monetary policy. So it's all interrelated. In the short to intermediate term, I actually, as I said, expect this to be a tailwind for the bond market because as the Fed lowers rates, it's going to make those yields we're seeing on 10-year and up, 5, 10, 30-year bonds, etc., look more attractive. As the yield curve regains a positive slope, while our long-term yields are higher than short-term yields, again, it makes those longer-term yields look more attractive to investors. And I do actually think that some of the money that's coming out of money market funds, that comes out of money market funds eventually, could be placed into U.S. government bonds to earn those higher yields as the yields on money market funds and short-term rates, T-bills, becomes less attractive. So I know that may seem a little esoteric, but I think it's a very important consideration. And it tells you a lot about the interaction of politics and monetary conditions and the central bank. Incidentally, I don't think that in the short term it really matters who is elected in November. I'm not saying that I don't care, and I know that probably many of you have very different opinions on what would be a better outcome, but what I'm saying is that in the short to intermediate term, regardless of who's in the White House come January 2025, I don't think that there's any prospect for the level of U.S. government spending or deficits to come down that much. So fiscal considerations are still going to be a consideration at the U.S. central bank, a sort of shadow driver of lower rates, if you will, whether the Fed admits it or not. So I hope you found that helpful. And for those of you who aren't yet already aware of smart bonds, I'd urge you to check out, we're offering a 60-day risk-free trial via the link below this video. So check that out. And if you'd like to sign up for the next 60 days, we have 3 model portfolios in the service covering a baseline allocation of only bond, credit, and preferred stock ETFs. That portfolio has done phenomenally well over the last since inception at the end of May. We're up almost 15% annualized in that portion of the service. We also have a defensive allocation, which is designed to have even lower volatility than the baseline bond ETF allocation. And then we have a third model portfolio called the Dynamic 60/40 portfolio, which is designed to shift its exposure to both bonds and the S&P 500, all using exchange-traded funds you could buy through your normal broker, depending upon systematic models as well as discretionary factors we monitor. So that portfolio has actually done the best of all. That's up around 18% annualized since the end of May as well. So I'd urge you to check that out. Check out the 3 model portfolios. Give the service a test drive for the next 60 days. If it's not right for you for any reason whatsoever, just give us a call or email us, cancel your subscription, and we'll give you a full refund no questions asked, and no hard feelings. Thanks again for listening to me today. Hope you found that enjoyable. Good night.